Okay, so hello and welcome to today's session. In today's class, we will cover our issue of September-December 2022 exam. Okay, and this question is related to September-December 2022 attempt, and it relates to investment appraisal. So we will do that question. I'm starting this question from the CB practice platform. So please follow. Exhibit 1. Short exhibit states that parafuels produces paraffin from crude oil, which is refined for use as jet fuel. For many years, parafuels was a private company, but it listed 3 years ago and now has a wide range of diverse shareholders, including institutional investors. Parafuels has a number of production facilities. Parafuels has a number of production facilities. Parafuels has a number of production facilities, and one of these is coming to the end of its productive life. Parafuels board of directors is considering two alternatives. The first one is replacing this production facility with a new facility, which will be modern and largely environmental friendly. This facility will continue to produce paraffin from crude oil and is based on traditional technology. The second alternative is based on converting household waste into paraffin using new technology, which has the potential to dramatically reduce environmental damage caused by air traffic. The board thinks it may be beneficial to convert the production facility based on this new alternative. Instead, there is a lot of uncertainty surrounding this investment. A competitor, Kiro Innovations, has suggested it may purchase the new alternative production facility at the end of its first 3 years of investment. Details of the production based on the traditional technology A and alternative technology B are given in following exhibits. It is anticipated that both investment A and B will have a useful life of 25 years. Parafuels cost of capital is 12%. Okay. So what is mentioned in this exhibit? That parafuels produces paraffin from crude oil. It is refined for use as jet fuel. For many years, parafuels was a private company, now became listed. Next, parafuels has a number of production facilities. One of these is coming to its end of its life. Parafuels board is considering two alternatives. First one is replacing this facility with new facility. This facility will continue to produce paraffin from crude oil and is based on traditional technology. And the second one is converting household waste into paraffin using new technology, which will reduce environmental damage. Uncertain is the area, and competitor Kiro Innovation is saying that the second alternative facility will be purchased by them at the end of 3 years. 25 years the life, and estimated discount rate is 12%. Now, Exhibit 2 is Investment A. The following information relates to Investment A, where Parafuels continues to produce paraffin from crude oil traditional technology. Initial investment will be 14 million. TAD is available at 25%, reducing balance in year 1 to 3. At the end of year 4, any remaining written down value can be written off as a balancing adjustment. As with production facilities of this nature, there will be no residual value of the 25-year project because of substantial decommissioning costs. Revenue in year 1 is 12.75 million. This is expected to increase by 5% per year in each of years 2 to 4. Production costs are expected to be 5.25 million in year 1. Pre-inflation amounts for year 2 for are given below as the annual inflationary rates for production cost in each of years 2 to 4. So pre-inflation amount, that means without inflation for year 2, 3, 4 is given, and inflation rate of year 2, 3, 4 is given. It is anticipated that working capital of 10% of revenue will be needed in years 1 to 4 at the start of each year, and that no additional working capital will be needed in years 5 to 25. At the end of 25 years, it is expected working capital will be required for decommissioning, will not be released. Parafuels pays tax at 25%, in which the liability occurs. Tax losses refunded at the end of the year in which the loss occurs. A tax on losses is refunded in the year. That means you get an inflow. You don't adjust it, you get an inflow. Estimate has been made of the discounted value of post-tax cash flows for year 5 to 25. This totals 5.4 million at the start of year 5. So discounted value of post-tax cash flows from years 5 to 25, because it's a 25-year life, right? So discounted values of post-tax cash flows from 5 to 25, they have directly given you the discounted values of post-tax cash flows, 5.4 million. Okay. Now, the next exhibit is investment B. Currently, the new technology used to convert household waste into paraffin is expensive to set up and run. Although setup and running costs are expected to reduce once this technology becomes established. The initial setup cost for investment B using the new technology are 34.6 million. That's the initial cost. Due to high costs and low revenues, after-tax free cash flows generated by this investment are expected to be 1.4 million in year 1. They are expected to increase by 40% in each of years 2 and 3. In year 4, when costs reduce and revenues increase, the after-tax free cash flows are expected to be twice as much as the year 3 amount. Now, no revenues and stuff is given, directly after-tax cash flows is given. Due to high level of uncertainty with investment, it is expected that annual after-tax free cash flows from year 5 to 25 will remain the same as year 4. It is possible that this is an underestimate, and in future, more realistic amounts can be determined. The annuity factor for 12% cost of capital based on useful life of 25 years is 7.843. Annuity factor is also given. Hero Innovations has suggested it may offer the purchase investment be at the start of year 4 for 27 million. Due to uncertainty surrounding this investment, cash flows are expected to vary by deviation of 40%. Risk rate of return is 5%. Okay. Then Parafuel's board met to discuss adopting the new technology for its production facility replacement based on converting household waste into paraffin. Following comments were made. The company's CEO gave an enthusiastic talk about the need for Parafuels to fulfill its environmental, social, and governance obligations. The chief marketing officer pointed out that it is likely that airlines around the world will face increasing pressure on their ESG agenda, and in particular, how they are helping to protect the environment. However, the CMO also said airlines will need to ensure this type of jet fuel is safe to use. CFO was more cautious. She pointed out that the fact that there is no binding contract with Kiro Innovations. She also said that while Parafuel shareholders would be supportive of the company pursuing an environmental agenda, majority of shareholders will be concerned if that led to a significant negative impact on corporate value. CFO reminded board that although only one facility needs to be replaced very soon, more will need to be replaced after 2 years. Nevertheless, CFO suggested that if the new technology becomes established and produces jet fuel which is safe to use, Parafuels will get the benefit of being one of the first companies to adopt the newer technology for production facility. This could be advantageous in terms of cost reduction and revenue maximization. Okay, that's it. So I think the scenario is not difficult at all. Information about the company, 2 investments, and then the discussion. Let's see the requirements now. So requirement A. Explain why Parafuels might include the value of potential offer from Kiro Innovations when considering investment B. So you know that in investment B, the second investment, Kiro Innovations offered to purchase after 3 years. So why Parafuels might include the value of potential offer from Kiro Innovations when considering investment B? B, report for board of directors, which calculates NPV of A, traditional technology, very easy, calculates the NPV of B, new technology, before taking account of potential offer from Kiro. The estimated NPV after taking account of potential offer, that's B SOP, I think, right? Based on financial grounds, recommend whether A or B should be undertaken, discuss the assumptions. This should be done prior to discussing the comments made at BOD meeting, discusses the comments made at BOD meeting, suggest how Parafuels may wish to proceed the new technology, professional marks will be adopted, and this is now 10, okay, from September, okay. Okay, so explain why Parafuels might include the value of potential offer from Kiro Innovations when considering investment. Now you see in investment B, it was a 25-year project, but there was a company, Kiro Innovations, which was saying that we will purchase this project from you at the end of 3 years. Okay. So why parafuels might include the value of potential offer from Kiro Innovations when considering investment? There are two schools of thoughts. First school of thought that your project is 25 years. Okay. So consider investment be over 25 years, find its NPV, and then consider the answer over 25 years. But if some company is offering to purchase that project at the end of year 3, consider that potential offer also when considering investment B. So it is asking why parafuels might include the value of potential offer from Kiro Innovations. Now you see, if you start a project, it has a 25-year life. And someone is saying, okay, we will get this project from you at the end of 3 years. If you ignore that potential offer, you will be bound that you have to complete the project for 25 years. That means the NPV you are calculating, the decision you are taking is based on binding force that my project will continue for 25 years. However, if you consider the potential offer in between when valuing investment, this gives you a flexibility or choice that you can find two NPVs. First, if I don't consider Kiro's offer, this is the NPV. If I consider Kiro's offer, this is the NPV. Whichever is the better NPV, you can go towards that, and this gives you flexibility to make better decisions. So better decision making is the sole point why you should include the potential offer when considering any investment. Because see, my investment B has a 25-year life. My investment B has a 25-year life. So when my investment has a 25-year life, okay, if I ignore Kiro's offer at the start of 3 years, I will be bound. My decision would only be based on the point that I will be continuing this project. Whereas in this case, I have a choice that whether I continue this for 25 years and either I shut it down and sell it to Kiro in mid. So if I ignore this Kiro's offer, that means I don't have any choice. I have to continue this project for 25 years. On this basis, my NPV decision is being taken, and this is the only thing I will communicate to my shareholders. But if I consider, okay, if not sold, this is the offer. If offer is considered, this is the NPV. I can check which option is better to me and take a sound decision. So if you consider potential offer, then it leads to better decision making. This should be your answer. Okay. Now, whenever I say that I am discussing this orally, obviously it is not possible for us to write everything as far as theory is concerned, but I'm discussing it orally. So please do refer to the examiner answer to get more knowledge about that. Okay. Now it's a report. You all know how we used to make a report. Okay, so we have discussed this thing multiple times that when you are asked to make a report, we start with to, from, date, subject, so to board of directors, from is not mentioned, date I've always told you, subject is new investment, told you just 2 words would be enough. Introduction, you know how to write the introduction. This report, and I've told you to write all requirements. requirement A. It then second requirement. So it then third requirement. It then, I think there is a fourth requirement as well. Copy paste from the solution. Okay. So this is the introduction, and then I told you that every requirement must have heading. Okay. Okay. Then I've told you that if the requirement is a calculation requirement, refer to appendix. If it's a discussion requirement, write it there. So estimated NPV, it's a calculation requirement. So we'll go in appendix. Appendix 1 shows NPV. Okay. So I will be moving towards appendix A now, which is the NPV. Okay, so I'm calculating NPV of investment A. So initial investment 14 million TAD, 25% reducing balance in year 1 to 3, and year 4 all amounts will be written off, and there will be no residual value 25 years. Okay, so I think we should start it in our traditional pattern that there is a 4-year life initially. One, two, three, four. Investment. So let us check what is the investment. So initial investment is 14 million. So take it 14,000. Okay, then we take revenues. So if you go in the revenue figures, 12.75 million, that means 12,750 and increasing by 5%. Okay. Okay, so this is what you got with revenues. And after revenues, there is production cost. If you go and check the production cost figures here. So in I think year 1, the production cost 5.25 million, 5250, and the pre-inflated amounts are given, and inflation is 6% per year. Okay, so it's 5250 in year 1. I will write negative 5250. Okay, now pay attention to year 2. It's 6.2 million, 6,200, but before pre-inflation. Inflation is 6% per year. So we'll apply 6% 2 times because 6% per year, annual rate. So in 2 years, 2 times. We will do it like this. 6,200 to 1.06 into 1.06 or 1.06 power 2. Sorry, 6200 into 1.06. Why? Because it states that production cost 5.25 in year 1. So inflation amounts for year 224. That means inflation will apply from year 2. Okay, because year 1 figure is given. So 6.2 million is for year 2. For year 1, inflation is not there because cost is given. For year 2, it's 6%. So in year 2, you just have to increase it by 1 time. Okay, but year 3 figure is 7.1 million, right? So it's 7,100. And the inflation rate is 7% for year 3, but 7,100 is pre-inflation figure for year 3. So it will inflate by 6% first to bring it to year 2 level, and then 1.0. 8053, and the year two figure 8,000,000. Okay. Revenue aspiration cost gives us taxable profit. Now, there are two approaches for the tax savings. Either this tax savings mentioned as 25% reducing balance method. So you apply the column of 25% RDB and then apply the tax savings at 20% and then mention it as inflow. Or the second thing is deduct TAD and then add back. So to maintain the answer with examiner, I'm doing that, but you can always use the other approach. Okay. So TAD is 14 million investment to 25%. 3,500, it should be negative. Okay. Year two TAD would be 14,000. Less 3,500. Net book value into 0.25. 2625. Okay. Year three TAD would be 14,000 minus 3,500 minus 2625. Into 25%. Okay, 1969. Okay. And what it has said about year four. At the end of year four, any remaining net book value can be written off. Okay. So whatever is remaining, you can write it off. Okay, now whatever is the remaining, that will be gone. So 14,000 minus 3,500 minus 2625 minus 1969. Whatever is left, it will be cleaned. Okay, 5906. So you do all this. Okay, so taxable profit amounts to negative 14,000. And you can check it's D87. Sorry, sum of D84 to D86 and drag on. Okay. Okay. So last year is giving loss and the other 3 years are giving profit. Okay. Then tax 20%. Zero has no profit, so no tax. Okay. So it's D87 into 20%. Okay. 800 should be negative. And you can drag them. In the last year, there was a loss. So remember the statement, it would be refunded rather than carried forward. So it was refunded positive. Okay. Then you add back D80. I will just adjust it to make them positive. $3,500 to 625. 1968.75. 5906. Okay. Now after TAD, there is scrap value, which is not there. Then working capital investment. And working capital recovery. So I think it was mentioned that working capital won't be recovered. Will not be released. So working capital, 10% of revenue in year 1 to 4. And at the end of each year, no additional working capital at the start of each year, and no additional working capital will be needed in 5 to 25. Okay. So 10% of revenue in year 1 to 4, you have done this multiple times. So in working capital in year 1, it'll be invested negative 10% of revenue, that is 1275. So it's at the start of year 1, so it will be recorded in 0. 12750. Okay, 1275 I invested working capital. Okay, then it will be working capital, you need to invest 10% of revenue year 2, that is E84 13387, that is 1338. So this will be invested, but you have already invested 1275. So 2613 further. No. 64 further. But make sure this 64 is kept as negative. It's at the start of year 2, so you will invest in year 1. Then working capital at the start of year 3. 10% of year 3 revenue. That is F84. Okay. So this will be 1406, but you have already invested 1275. You remember from my classes, and already invested 63.75. So now you will only invest 67. Okay. Since at the start of year 3, we'll record it in 2. And working capital at the start of year 4 is 10% of G84. 1476. But you have already invested 1275. We have already invested 63.75 and we have already invested 67. Okay, 70 more. Okay, and no recovery. Okay, then scrap value, there is no, the tax savings from capital allowances will not be needed. It will be only done when you didn't do this DAT approach. Okay, so once you net them all, you will get the net cash flows. Equals to sum of C87 So the traditional practice was net cash flows into discount factor, that is present value. Okay, now you don't need to apply the discount factor approach. Okay, what you can simply do is stop at NCF and then use the NPV function. Okay, so what was the NPV function? So for NPV via function, what you can do is, because you have to gain professional marks, NPV, as I told you, bracket open discount rate. So discount rate is 12%. So we wrote 12%, comma, NCF from year 1 to 4, that is D91 to G91, bracket closed, plus the investment cell, that is C91. You get the NPV by a function, double to A3 positive, but remember this NPV is from year 1 to year 4. There is still some issues left in this question because it was continuing for 25 years. So this is the NPV for year 1 to year 4. At the end of 25 years, it is expected working capital required. Now the last line, an estimate has been made at the discounted value of post-tax cash flows from year 1 to 5 to 25. Discounted value, that means multiplied by discount rate. From 5 to 25, this is 5.40 million. Okay. So this is the NPV from year 1 to year 4. Now, from year 5 to 25, the discounted value means present value has been computed. The present value is 5.4 million, that is 5,400. But it's from year 5 to 25. It's from year 5 to 25. This is the discounted value from year 5 to 25. Okay, we are calculating NPV now today's terms. So this 5400, the figure is from 5 to 25. Okay, that means after 4 years. To bring it at today's level, we need to multiply it with the year 4 discount factor at 12%, 0.893, 0.797, 712, 0.636. Okay. 3434, and then you add them. So you get total NPV that is worth 9 marks. Sum C93. $5,718. So this was worth, I think, 9 marks, 9 easy marks. Again, repeating the other point that the NPV you have calculated, that's from year 1 to 4. After year 4, that means 4th year onwards, it's 5,400 from 5 to 25. So to bring it at today's level, we need to multiply discount factor of year 4. Okay, so you can copy this and then we will move forward. Okay. Okay, so I think the requirement 1 is now done from the reports portion and NPV of project A. Now we will move towards the second requirement. NPV of B before taking account of potential offer from Kiro, and estimated NPV after taking account of potential offer from Kiro. This is also worth 9 heavy marks. Okay. So I'm opening the details of investment B now. Currently, the new technology used to convert household waste into paraffin is expensive to set up and run. Although setup and running costs are expected to reduce once this technology becomes established. Initial setup cost is 34.6 million due to high costs and lower revenues initially. After tax free cash flows generated by this investment 1.4 million in year 1. Direct after tax free cash flows are given. Increase by 40% in year 2, 3. In year 4, the after tax free cash flows are expected to be twice as much as the year 3 amount. Due to high level of uncertainty, it is expected that annual after tax free cash flow from year 5 to 25 will remain same as year 4. It is possible this is an underestimate, and in future, more realistic amounts can be determined. Annuity factor for 12% cost of capital based on useful life of 25 years is 7.843. Key renovation was suggested it may offer to purchase investment at the start of year 4 for 27 million. So you all know this is an option of early exit will be dealt through BSOP due to uncertainty surrounding this investment. Cash flows are expected to vary by standard deviation of 40%. Risk rate of return is estimated to be 5%. Now, if I go in the main spreadsheet part, $5,718 positive. So appendix 1 shows NPV, which is 5,718 positive. No need to comment, but for professional skills, you can write, which suggests investment A is financially viable, but company will also consider some non-financial factors before making final decision. Okay. Appendix 1 was mentioning NPV. Now the requirement 2 is also seemingly a theoretical requirement. So it will also be done via appendix. So you can write appendix 2 shows NPV with and without heroes offer. So let's just start finding the NPV with and without the Kiros offer. And for that, I will be moving towards appendix 2 now. Okay, now trust me, this is a very, very easy part to secure 9 marks. So you see that the NPV of investment 2, setup cost 34.6 million and 1,400 in year 1, 40% in year 2, 3, and twice as much as year 3. This is after tax free cash flow. That means we don't have to do any working. Directly after tax free cash flows are given. So let's start 0, 1, 2, 3, and 4. Okay. So you write the investment as 34,600 outflow. And you get directly after tax cash flows. So if you go in year 1 with after tax cash flows, I think it's 1,400. Yeah. Increasing by 40%. So 1,400 I increased by 40%. Then increased by 40%. And then twice as much as year 3 in year 4. That is twice. Okay, this is the after tax cash flows. I will just discount it to get present value, but annual after-tax free cash flows from year 5 to 25 will remain same as year 4. Okay, so you can write that from, or make it separately like I did above, year 5 to 25. Same as year 4. 5, 4, double it. Okay, you net them all to get net cash flows. So negative 34,600. Discount factor 12%. You know, for year 1, 0 is 1, 0.893, 0.797, 0.712, 0.636. For 5 to 25, you know, you need the annuity factor for 25 years, 1 minus 1 plus r power minus n over r, and then deduct the first 4 years, or you can directly see the question. It states the annuity factor for 12% based on 25 years is 7.843. So the annuity factor is 7.843 for 25 years. But when you calculate it or you state it's 7.843 for 25 years, 1 to 25, I need 5 to 25. I need to deduct the first 4 years. So I will less 0.893, 0.797, 0.712, and 0.636, because from 1 to 25, if first 4 years are gone, you are left with 4.805. Okay. Net cash flows into discount factor will give you present values. Okay. So C101 into C102. Okay. And then you net them all. You get NPV, sum of C103 to H103. Or could have also used the function. Okay. You could have applied the function as well, but if you're not applying the function, that doesn't mean that you are doing something wrong or stuff like that, because Okay, so that doesn't mean that if you don't use the function, you won't gain marks, but still in professional marks, I think the function usage is more better. And usually the function should be used in basic NPV questions. Without basic NPV questions and NET stuff, it may create problems for you as well. Okay, so we have got the NPV now. Okay, now the next area, this is the NPV without Kiro's offer. Okay, now if you are trying to find NPV with the Kiro offer, okay, let us try this now. Find NPV with Kiro offer. Now, as you can see, Kiro off is an option to early exit, right? Because this is 25-year life. They are saying at the end of year 3, we will take it from you for 27 million. At the start of year 4, that's the end of year 3, 27 million. So it's an option to early exit. So value will be found through BSOP. Okay. Now in BSOP, for the professional marks, you know that for BSOP you need 5 things: PA, PE, R, S, T. Okay, but rather than doing everything here, you have the BSOP calculator. You will write everything on this BSOP calculator. Okay. So I will just first write it here that PE is the competitor's offer, that is 27,000. Okay. R is the risk-free rate. That's 5%. 5%. Okay, standard deviation is 40%, and time is start of year 4, end of year 3, 3 years. Okay. %, and time to expiry in years is 3. And PA is the present value of opportunity cost. So if obviously you sell the project at the end of year 3 to them, you will lose these two cash flows. So the present value of opportunity cost will be the sum of both of these. You will lose 3490, that is G103 plus G104. Sorry, plus H103. Okay, now just put all these in the BSOP calculator. And you all know that option to early exit is a put option, right? So PA is 29860.21. PE is I think there is no option to expand the space of these cells. Yeah, no. So let's do it in millions. 29.86 million. The competitor's offer is 27 million PE. So our risk-free rate is 5%. T time to expiry is 3 years. And standard deviation is 40%. So as told that standard deviation is 40% here. 40%. And time to expiry is 3 years. Risk-free rate is 5%. This is 27 million. And this is 29.86 million. Okay, so we get the values of call and put options, but we all know that options to early exit was a put option. So this is the value, okay, for the put option as found through this BSOP calculator. Okay, and If you go back to the Excel sheet again, that value of this option under BSOP is 4330 or 4.33 million through BSOP calculator. And strategic NPV will be this 4330 plus that without option 26.56 thousand, the one without offer and the one with offer. Okay, so 4330 and this 26. So this will make it 4356. Okay, so we have done this 9-mark requirement as well. If you want to note, you can, and then we will move forward. Now 18 marks requirement are left. Theoretically, we will do them. Okay, now. Based on financial grounds, recommend whether investment A or investment B should be taken and discuss the assumptions made in the calculation. This should be done prior to discussing comments made at the BOD meeting. So don't discuss comments at the BOD meeting. Just recommend whether A or B should be taken and discuss the assumptions made. Okay. So if you just start writing the answer regarding this. For the 7 marks, firstly, recommend whether investment A or B should be taken. So you can just write that investment A's NPV is 5718 and investment B NPV without considering offer and with offer in both cases is less than investment A. So that means considering financial grounds only. It's asking on financial grounds. We should recommend investment A. This is the only answer, no need to make it unnecessarily prolonged manner. That whether investment A or B shall be undertaken on financial grounds, investment A's NPV is 5718, investment B's NPV even without offer and with offer, both are less than A. So we should opt for investment A. However, there are some assumptions, and I have told you that write 4 or 5 assumptions. Sometimes it is in the question, and sometimes it is you need to write them on your own. So you can just highlight from the question if there are any. You cannot find a statement, it can be assumed till now. Okay, so we can write on our own 4 or 5 assumptions that project life is 25 years. Okay, so estimation of cash flows may be a bit assumed figure. Okay, it has been assumed cost of capital will remain constant throughout the project. It is assumed that discount rate will remain constant throughout the life. It is assumed that all estimates related to revenue and variable costs are accurate. However, some sensitivity analysis may be required. So all these assumptions I have told you, standard deviation and the risk-free rate, they are also assumed figure. In this, you have also applied BSOP, so you can write assumptions of BSOP. So in my opinion, these 7 marks were very easy because whether A and B should be undertaken, you decided that whether we should go for A or whether we should go for B. So ideally, investment A offers higher NPV than B, so it should be undertaken. Assumptions regarding cost of capital, regarding the tax rate, regarding the life, regarding revenues, and you can write the assumptions of BSOP as well, so it can easily secure you 7 marks. Okay. And discuss the comments made at the BOD meeting, suggest how parafuels may wish to proceed if new technology is adopted. So discuss the comments made at BOD meeting. So what are the comments made at the BOD meeting? There are 11 marks for that. CEO gave an enthusiastic talk about social government ethical responsibility. CM pointed out it is likely airlines will face increasing pressure and airlines will ensure that this is fuel. CFO states that shareholders will be concerned, and he gave a positive point regarding this as well. Now, there are 3 comments made at BOD meeting, right? So you can discuss each of these 3 comments. The first comment is CEO. He is solely concerned, his comment is solely concerned towards environmental and social obligation. Now, these days, companies are increasingly concerned towards that environmental and social obligation. So, in his opinion, that if we go towards the second one, household waste, we will fulfill our ethical and social responsibilities. Okay, so this is a good thing. The company will enhance its public image, but CMO's concern is also correct that airlines want this, but they must ensure that the jet fuel is safe to use. So whether you should go for it or not, and it entirely depends on the safety. Okay, then you can discuss the CFO's comment that it was more cautious because CFO usually is interested in financial factors. So he is comment that shareholders will be supportive, but if it reduces value, then definitely the shareholders will be concerned. So how we will address the shareholders' concerns, this is the matter which should be considered. And the third comment of CF is good, that there is always an early mover advantage. Like if we talk about our organization, even before COVID, we entered into online markets. We didn't know that COVID is going to come, but still we entered into online market. Now, on the basis of that, our presence around the world is more obvious and more healthy compared to our competitors, is mainly because of the early mover advantage, that they entered late post COVID and we entered before. Okay. So this can help you because of early mover advantage as per the comment of CFO. Okay. But it's not just about discussing the comments. Its suggestions, discussing the comments may suggest how Parafuels may wish to proceed. Now, you have discussed the comments. You can write any pros and cons relating to this comment, but how Parafuels may proceed if the new technology is adopted. So if the new technology is adopted, first they need to ensure that they are completely telling all the companies and airlines to use this, that it is safe. Possibly they can hire a quality control firm who will give them certification that the fuel is safe to use. So they can do that. A quality control firm they can hire. Secondly, they can use good marketing to ensure that they market this, that there is no commercial intent behind. We just want to focus on environment. Okay. Similarly, obviously the offer without Kiro is very less. The NPV is very less without Kiro, and it is more with Kiro. So they can sign a contractually binding contract with Kiro that it doesn't back off. So this is some of the points they can proceed. So however, it was a very good and easy question as far as my opinion is concerned compared to examination standard. So we have completed that. Now we will be ending this class. Thank you. It's my advice as always that do read the examiner answer so that you can always refer to the solution, and we can always read the examiner answer to know that whether professional skills are easy professional marks or they are something very normal. Thank you. Do read the examiner answer.